All right, so in this video, we're going to talk about permanent life insurance. Okay, just like the name, permanent insurance covers you for your whole life. So, not just a set period of time, but the entirety of your life. And so, as you can imagine, if you think through this, the odds of you dying during this coverage period are 100%. You will die during this. So the insurance company knows you're going to die. They run all the statistics and all the probabilities of when that could happen, but they know you're going to die. And so the risk to them is 100%. They are going to pay out a death benefit. Therefore, because it's a certainty, your premiums are going to be higher because they are actually going to pay out. With term, they may not pay out. In fact, the probabilities show that maybe they won't in most cases. And so your premium can be low because they're not assuming a lot of risk. In this case, that it's the opposite. Okay, they are assuming all the risk because you will 100% die during that period at some point. Okay, so premiums are typically higher. Now there are a number of different types of permanent insurance. I'm not going to talk about all of them, just the most common ones, which are whole life and indexed universal life. The difference being, I'll cover the difference here in a minute, but those are the most common ones that I see and that people ask me about. So I just want to make sure that I cover those in pretty good detail. So here's the way that it works. With term insurance, all of your premium goes to fund your death benefit. Okay, they receive your premium, they go and invest it in their big pool, and when there's a death benefit claim, they pay it out of that pool. It's a little bit different with permanent insurance. A portion of your premium goes to fund the death benefit, but then another portion of your premium goes to build up a cash balance within your policy. Okay, and so your premium is actually funding both of these. So this cash balance, right, this cash value that's growing inside of the policy is just a feature of these permanent insurance policies. And if it's whole life, it earns an interest rate, typically a guaranteed interest rate by the insurance company, right? It's in the contract, commonly 4 or 5%. It's fairly common. And so your cash value is in there growing. It's not taxed year over year, it's tax-free growth. But at a certain point, you may be able to stop paying the premiums, and any premium that is due, they can actually pull it from the cash balance. So you may actually build up enough cash balance that it funds the premiums and you can stop paying those at some point. So in whole life, there's an interest rate, typically guaranteed, usually around 4 or 5%. With index universal life, it accumulates a cash balance, but instead of having a guaranteed interest rate, you can actually tie it to an index in the market, like the stock market, like the S&P 500 or other indexes that the plan may offer. Generally speaking, they provide a range of returns. So they might set a floor and say, hey, you are not going to get below this amount, and they will cap your participation on the downside. Okay, so it might be 0. Like, okay, you can't go negative in your return. Okay, so we're going to cap you. Okay, that's not always the case. Sometimes you can actually lose money. Okay, they don't have the range. You can just lose the money if the market goes down. So that would be bad because then you would actually have to fork up more money, right? You would have to pay more into the policy just to bring it back up to even. But sometimes they cap it, right? So there's a floor, and then they also set a ceiling and say you can't participate. The market's up 20%, we'll cap you at 9, or 10% we'll cap you. And the rest of the return goes to the insurance company. They just take that. And so they might cap your downside and upside so that you can bounce around. So there's less risk, but there's also less potential return. So that's indexed universal life, indexed against potential to grow based on the stock market indexes. So as this cash value accumulates and grows, you have a couple different options, right? It can fund the premium. You can stop paying the premiums. It can fund it. You can also take out loans against the cash value. We've talked about this in previous modules, just like taking out a loan and on any collateral, right? Your home, like a home equity loan or a home equity line of credit based on equity in your home, using your home as collateral to get money, or an S block, securities based line of credit. You're using your stock portfolio, right? Investment portfolio to take a loan against it as collateral. So just the same way, you can do the same with cash value in a life insurance policy. Now, whole life policies, generally speaking, pay out very large commissions. This is just something to think about. And one reason that life insurance or life insurance reps, sales reps get in such a bad rap is because there are a lot of people out there pushing products where they don't really fit. They have so many examples of this that it's hard to keep track of. I've just heard this time and time again. I've seen it up front, up close and personal with clients that have been sold policies that they didn't understand and that they actually don't need. And they're paying an arm and a leg for these premiums because the premiums are more expensive for the death benefit, as I've explained. And so there's a lot of groups that really push whole life. Term life insurance does pay out a commission, but it's very small. It's very, very small compared to a whole life policy commission. And so there's groups out there, right? And you're a salesperson and you're just out there selling whole life, okay? There's a lot of financial advisors. I'll put that in quotes because it's a very, very broad term. But financial advisors that work for these insurance companies, you can probably think of some probably have approached you or met with you or tried to sell you a policy. They work for them and they say, hey, we want to put together a plan. And then it's all based around their solutions on their insurance products that typically include a lot of whole life, which are very high commission products. Okay. That's just the way that it's pushed. That doesn't mean that whole life insurance is a scam, and it doesn't mean that it's a bad product, but it does mean that it gets pushed a whole lot more often when it doesn't fit. Okay, so that's something to keep an eye on. It's important. I know like Dave Ramsey hates whole life insurance. He does think it's a scam, right? There's a lot of people out there like that. I'm not one of them. I think it can fit, but first things first, you have to protect against loss of income. And I don't think that's done especially effectively with whole life. It's done more effectively with term life. But whole life can fit, especially if you want coverage for a lifetime and you want to be able to have a death benefit that is guaranteed and that is passed on to your beneficiaries. So depending on how the policy is structured, there's a lot of ways to structure these. A good chunk of the commission can eat into the cash value, how much cash value you actually have. And we'll talk about this in the infinite banking strategy video. We'll talk about how some of these are structured in a not so advantageous way. But your premium, if a big chunk comes out as commission, then very little is actually going to build your cash value in your account. So it can take years and years to actually break even in that type of account because of the commissions, the heavy commissions up front that you pay. So I want to give you an example here of a client had a relationship with a financial advisor at a very large life insurance mutual company. And essentially the planning that they did included them just buying a lot of whole life insurance. This happens so often. And yeah, anyways, so it just was that way. Okay. So we looked at the policy. There's a whole life policy. She received, so she was early 30s, healthy female. Okay. She received $80,000 as a death benefit. That was the coverage. And it cost her $750 a year in premium for $80,000 worth of a death benefit. Okay. That's going to protect her, right? Cover her for her entire life. So they're going to pay out $80,000 no matter what, as long as she continues to pay the premium and the policy doesn't lapse. So that seemed high to me. And so we went out and we got quotes and we found that term life insurance, she can actually get $600,000 worth of coverage for almost half the price. It was around $400 a year. Okay, so you can see the massive difference in coverage and cost between term and whole life. Why? Well, term life, I think it was a 20-year policy is what we were looking at. I can't remember exactly this now, but they're going to cover her for, let's just say, is the 20 years. And her probability of dying in that 20 years is low. So low risk to the insurance company equals low cost premium. With whole life, she is 100% going to die at some point, and they will 100% have to pay out her $80,000. And so the premium, there's a lot more risk to the insurance company because they are guaranteed to pay it out. Therefore, premium is higher. Okay, that gives you an idea of the cost difference. And if we're young, we're looking to replace, lifetime income and make sure we're not financially ruined if we die early, that our family isn't left in such a bad spot. then you can see why term life insurance is such an effective option to get a large amount of coverage for a much lower premium. So if you do want coverage that extends during your lifetime, then you can do hybrid, right? You can get term to cover the bulk of that, your working years, significant amount of money. You can get a large death benefit, and then you can get some supplemental whole life policies that will cover you for your whole life. Okay. So a lot of ways to do it, but I think for young people, especially, term makes the most sense initially. And then if you want to explore other types, then you can. Infinite banking strategy, if you want to employ that, again, we'll talk about that in future videos. Then whole life insurance can make sense if you want to go that route. So we'll talk about that then. But this basically covers the main ideas and concepts here in permanent insurance. So factor these in. If you talk to an insurance agent, make sure that this fits within a plan and they're not just pushing it, just walk away if they're pushing it so hard. I just talked to an agent the other day who was asking for advice because he likes certain products. They work really, really well within a plan. So he works with advisors when they have a client that has a gap that needs to be filled by one of these products, that he goes in and he fills it, and it just makes sense within the context of the whole plan. Well, he recently affiliated with an insurance group that all they basically do is they just push whole life insurance to anybody and everybody with a pulse. There's a lot of sales pressure, a lot of pressure to hit quota and continue to drive in the commissions. And it's just a not great environment. And he's not happy, right? Because the products can make sense in certain situations, but they're not universal. They don't make sense for everybody. That happens a lot. It's just kind of the nature of the beast. So be careful, do your homework, and make sure it fits within your plan. All right. Okay, that covers this video. See you guys in the next one.
Every clear choice brings you closer to the life you want.